What about the impairment of all the assets other than goodwill? Now, first remember, if it's a finite life asset, there's a two-step impairment process. First is a little more, a little more relaxed. We are saying, see, don't go into the hassle of figuring out what is the market value of the product. You just figure out what is the amount. So CA is your carrying amount, okay? So what is CA? CA is the carrying amount of the asset. So in your books, what was the acquired value less the accumulated impairment and accumulated amortization? That figure gives me the carrying amount of the assets. So CA is your carrying amount. What is the carrying amount? This is also called the net book value in your books, which is the historical cost at which you capitalize the asset. And from here, you've reduced the accumulated amortization and the accumulated impairment. So you know at what figure are you carrying the asset in your books. Now you want to pitch that figure against the undiscounted future net cash flow. So imagine if I have an asset at 20,000 in my books and I add the benefit that I'm going to get for that asset. So patent, if I'm going to lease out that patent, I'm going to get some figure which I'm not even discounting. So imagine if I'm going to get 5,000 over a period of 4 years or 5,000 over a period of 5 years, let's just say. So 20,000 was the cost in my books, 5,000 over a period of 5 years, 25,000. So I'll say, okay, more or less, I am going to recover my cost in the times to come. Let me not bother about the discounting at all. So first, what I'm going to do is when the conditions so exist, because if it's a finite life impairment, I do not have to test it for impairment every year. I will have to wait. So review for impairment only if the events or changes in circumstances indicate a possible loss. I don't have to do it yearly. If there are conditions and circumstances that make me believe that yes, there may be an issue, then I'm going to test it quantitatively for impairment. How do I do that? First, I'm going to compare the value that is being shown in my books and pitch it against the undiscounted future cash flows. If what I'm going to get is more than what I have in my books, I'm just going to forget the discounting. I'm going to say, no, the asset is not impaired. But if it is the reverse, the value that I'm showing in my books is more than what I could potentially get over the usage of the product. And even if that undiscounted figure is lower, then I know for sure the discounted figures will be further low, right? If I'm going to receive 5,000 over only 3 years, then I know 15,000 is anyway less than 20,000 and my asset is impaired. But now when I book the actual impairment, I know I'm not getting this 5,000 right away. I'm going to get this 5,000 over a period of 3 years. So then I will discount it at today's day and take the discounted cash flows. The market fair value is a substitute to discounted cash flows. So step one, you know the number of years we're talking about. Figure out the undiscounted cash flows, pitch it against the carrying value. If the carrying value is lower, forget, because you know that I'm going to get more than what I'm carrying in my books and I don't give regard to the discounting. But if my carrying value turns out to be higher than the amount which is undiscounted that I'm going to get over a period of years, then I know my asset is impaired. Now when I'm booking the impairment loss, I have to discount those future cash flows, or I can take the market value as is prevalent in the market, because that is supposed to be the discounted cash flow. And the delta between the value at which I'm carrying the asset in my books and the fair value becomes impairment, which I'm going to book in my books. The journal entry will be impairment loss account debit to the accumulated impairment or to the asset account. Here is your impairment loss. If it is an asset which was held for disposal, so if it is a discontinued operation, I will also add the disposal cost to it. Okay, please remember, under no circumstance will you be allowed to reverse the impairment losses unless the asset is held for disposal. So what do I do? First question, is it continuing operation, discontinued operation? If it is continuing operations, just take the carrying amount minus the fair value is your impairment loss. Reversal is prohibited. If it is a discontinued operation or a disposal activity, I'm going to add the costs of disposal and the amount by which I would have impaired it. If the circumstances improve, I can again restore it, but only till the amount that it was impaired. So reversal is permitted provided it is only an asset that you're holding for disposal. Where I'm going to show the impairment loss, it is reported as a component of income from continuing operations before the income taxes. Now, if it is an indefinite life intangible, then the quantitative yearly impairment analysis is a must, where you have to figure out what is the discounted cash flow or the market value compared to the carrying value. You can do it earlier than annual if the circumstances exist. There may be indications of impairment. Okay? Two more questions and then we'll be done. A patent was purchased on 1st of January year 1 for $8 with a useful life of 5 years and no residual value. At the end of year 2, an event occurred indicating that the asset may be impaired. The fair value of the asset is 460 and the undiscounted future net cash inflows are 475. So if it's a patent, I know it is a finite life intangible asset. So I'm going to follow a two-step impairment. What is the carrying value versus the undiscounted future cash flows? Can anybody tell me quickly what is the carrying amount of this asset? Anybody? What is the carrying amount of this asset? I bought this asset at 800,000 in my books. I'm going to impair it over a period of 5 years and I have used it for 2 years. So my impairment becomes $320,000. How did I get this figure? I started with the historical cost of 800, divided it by 5, have used it for 2 years. So the asset carrying amount in my books is $480,000. The undiscounted future cash flows is $475,000. So my carrying amount is more and the net result is that I have an impaired asset. Then, so this is my step 1, okay? Then I go to step 2 when I'm going to compare the carrying amount with the fair value and book a loss. So what is the impairment loss? It is the difference between my carrying amount and the book value of 480 and the discounted cash flow. So fair value is also equal to discounted cash flows. So the impairment loss that I'm going to book in my books is $20,000. So how much is the impairment loss? $20,000. This is clear? Very easy, isn't it? Very, very easy. Now we go to the next question, the last MCQ for the day. A company has a trademark. Now this is an indefinite life intangible asset whose amount is 850 and an indefinite useful life. See, in case if they don't give you this also, you should be able to identify the asset and the fact whether it is a finite life or an indefinite life intangible asset. At the end of year 4, an event occurred indicating that the asset may be impaired. The fair value of the asset is $8,000. Undiscounted future net cash flows is $90,000. Tell me, is the asset impaired? Is the asset impaired? See, this, can you see? This is a redundant information. It is an indefinite life intangible asset. I'm not bothered with undiscounted cash flows. So is the asset impaired? The carrying amount is greater than my fair value. The carrying amount is 850. The fair value is 800. So there is an impairment loss which is equal to carrying value minus fair value, which is $850,000 minus $800,000, which is 50. Or you can book it to accumulated impairment on trademark of $50,000.